everybody, it's Jane Johnston with the Briar Hill Group at Remax Camosun, co-host of He Said, She Said, They Said, a real discussion in real estate with Andrew Plank. Andrew is not here today. With me today is going to be my guest, Anthony McLachlan. We're going to be talking about mortgages and answer a few key questions that you need to learn about when you're getting ready to finance or maybe even sell, getting qualified before you sell. But before we get to that, first, we're just going to talk about what's happening in the market. So we have 196 new listings with 218 pendings. This is probably the first time in a long time that our list to sale ratio has gone over 100%. I think the last time was in March. And we've had a price decrease of 40. We've had a price increase of 2. And 249 listings have sold so far in the past week. Now, this month. A lot of sales will be happening this week just because a lot of people want to move the last week of August, kind of end out the summer where they are, and then move starting new in September. So I expect that number to be huge at the end of the week. Year to date, we have 566 unconditional sales for August 2021. That's compared to 979, and that was record-breaking last year for August. We have 659 new listings, and that's compared to 1,333 last year in August 2020. So we are down. So now is a great time to sell if you want to. You're almost guaranteed to get it sold if you list it well. And in terms of total active listings, we are still low at 1,249, and that's compared to 2,584. And I just realized I forgot to share the screen with you, but that's okay. We have the data. Let's get to the meat of the presentation, and that is Anthony McLachlan. Welcome.
Thank you, Jane.
That's what I get for doing it by myself. So, first of all, tell us a bit about yourself. So, what company do you work for?
I work for Mortgage Architects, and I moved to the island a little over a year ago now. It's been fantastic out here, getting acclimatized to the island lifestyle. And I've been a mortgage broker for a couple years now, and loving it.
What do you find is the biggest challenge with people buying now, being first-time buyers, or what's the one thing that they need to focus on before they come to you?
Well, I think one thing that folks need to focus on is, I think the first thing you should do is when they're thinking about buying is go to a mortgage professional because there's a lot of unanswered questions that you can get out of the way ahead of time. And it could be things in terms of, basic question of how much do I qualify for? But you can also, from there, if you start the process early enough, you can change your financial situation well ahead of making a purchase. Let's say you're like, okay, we want to be homeowners in 3 months. That's fantastic. But if you're being priced out of the market, if you've got some debts on the side that maybe you need to consolidate or just wipe out entirely, it's good to know that ahead of time so that you can buy what you want to buy and you're not stretched too thin once you get into your home and you can be happy. So there's a lot of things to consider. I think just starting the process as early as possible and working with a trusted, reputable mortgage broker is the best way to do that.
Yeah, I just want to remind people, if you have a question, you can ask Anthony. We did get a like on one of your comments there. And I just want to say that it's so true that if you start with a plan in place, like for instance, you don't plan your retirement at age 60, you should start planning your retirement at age 20 so that you're in touch with the right people to help you make the right decisions to get the whole picture ready for when you are ready, right?
Exactly. Yeah. And there's nothing that's more sad than when I get a pair of first-time home buyers and they're so excited to get in the marketplace and they realize that they've got a lot of other things they need to consider before they're going to get there. And when it's the largest investment you may be making in your life, in your late 20s, early 30s, whenever you decide to buy, it's good to know where you stand well ahead of time.
Okay, so I'm just wondering, a lot of people use mortgage calculators online. And so they kind of, to me, they're a lead generation tool that pre-screens people. They put in their confidential information, they stick it out into the ether. What are those good for? Should people be using them or what?
I think they are a great tool because usually there is some good information there, and things like what's the difference between a fixed and variable, what are the things you need to consider, what are my total monthly costs going to look like, because it's not just the mortgage, right? You have to take in consideration, are you paying strata fees, what do my property taxes look like, things like of that nature, right? And so yeah, they're good in that sense that it's nice to have some clients come forward who are a little bit educated on what the process or things that they need to consider look like. But at the same time, they are lead generation tools. And when you punch in your information and it says you can afford this, I would take that with a very small grain of salt, because those tools aren't checking your credit history. It doesn't know how much debt you're already servicing. And ultimately, it's going to be potentially very, very inaccurate. And if you go in and say, oh yeah, I think I'm pre-qualified, and put down a deposit to purchase a home, and then you don't qualify for that mortgage you thought you could, then things get very messy for you. So it's best to have a full diagnostic of your financial situation, so that you know full well that when you put in an offer and give up a nice chunk of change on your deposit, you're going to be secure and you know that you're going to close.
Okay, so I agree. So I used to say it's kind of like taking a kid to a candy store. They want to know how much money they have in their pocket before you let them look at the candy, so that they don't ask for too much. And otherwise, you don't want to go through the emotional roller coaster ride. But often too, when somebody writes an offer, we have 7 to 10 days, and those are real days. So like 5 to 7 business days to really get the financing in order. So they have to have everything ready before they come to us. And usually what I do is I introduce them to the broker. So someone like you or my friend Jen Lowe, and who is going to qualify them so that when we go into the offer, they have the minimum amount of documents that they need to provide. So often, like I would say, meet with your mortgage broker early on so that you get your picture ready and start collecting a file folder. I say and I don't know, maybe I'm wrong, but I have a Dropbox folder with all of my notices of assessment. Mm-hmm. I have pay stubs in there. I have my mortgage documents in there, and like for the house that I own, and then other documentation about debt. Is that a good idea?
Absolutely. Yeah. I mean, if you put in an offer, sometimes I'll speak to a client, we'll get fully underwritten, and then we'll maybe be missing a few documents. If you put in an offer, but you have a condition on financing, but we need documents, maybe we're missing a job letter, and your company decides that, oh, it's going to take them 4 days to issue it. Well, that's 4 out of our 7 business days gone to be able to waive our condition on financing, because we need to get that document sent over to the lender and approved. They got to finish their underwriting and send us our commitment, or our conditional commitment. So yeah, definitely make sure that you have all your documents up front ready to go, so that when the purchase happens and you just want to make sure that you have no trouble getting financing and you have that condition in, we can ship it all off. And 5 to 7 business days is plenty of time to get a commitment back from a lender.
So things like if you have a separation from your spouse, to have a separation agreement.
100%. Yeah, absolutely. I mean, folks, I've had to request that multiple times now. And I mean, obviously it's a sensitive issue, and but you have to understand from the lender's perspective, if they're going to be loaning you, call it $600,000, they have a right to know how much of your annual income maybe is going to be directed to your former spouse. So these are things that really need to be considered ahead of time. And even something as simple as what type of income do you earn? Are you T4'd, straight up salary? Or do we need to see your T1 generals because you draw dividends to pay yourself? I mean, there's things like all that's going to show up on your full T1, and we're going to see your rental property income, and then we need the mortgage statements and the tax, the property tax statements from that property too. So being as clear as possible up front so that your mortgage professional knows what the whole picture looks like, not just a little snapshot of it, is going to save you a lot of stress and a lot of time down the road.
Okay, so say I have a client who's interested in buying a home, and they're a first-time buyer, or maybe it's somebody who hasn't been a first-time buyer before with a first-time buyer. What are the steps to qualification? I say, here, Joe, meet Anthony. Anthony, take it away.
So every mortgage broker, mortgage professional will have their own process. But for me, what I like to do is once I get that notification that, hey, here's Anthony, I like to hop on the phone with the clients as quickly as possible, just to have a quick discovery call. And all we're doing is getting to know one another and kind of doing a light dive into your financial situation, where you are in the process, and what your expectations are. And then from there, I send over an application and a list of documents that I require. So through that phone call, I've already figured out, are you T4 income or are you self-employed? So I know kind of what we're looking at in terms of the documents that we need. And then I'll also ask you, do you own any other properties, things like that. Yeah, and then so once we have our list of documents and our application, which really these things don't take too long to put together. Then I take a day, maybe two, put all those together in our online application software, which allows me to submit directly to the lender. And then I like to do a more in-depth call, which is I like to call my strategy session, and we do a screen share and help folks understand what it all means. What are my GDS and TDS ratios? How does this all fit into my mortgage payment? Really go through the entire mortgage process step by step so that the client is as informed as they can be on one of the largest investments they'll make in their life. Because I personally like to have my clients be savvy and knowledgeable about their mortgage, because it's just going to serve them better 5-10 years down the road. If you get set up with a mortgage really quickly and you don't know how it works, it's not going to serve you if your plans change in 3 years. So it's best to kind of have a plan and yeah, go over things in solid detail. Okay,
so you used a bit of terminology there, GDS and TDS. Do you want to show us? You were going to screen share. Are you able to do that?
Yes, absolutely. Let's pull this up. Screen share.
Mm-hmm. And I want to say that sometimes there are people who don't have credit. So that's one reason to talk to a mortgage broker, is because you want to start establishing your credit by getting a credit card and paying it off. So I actually had a client who went down to the States for 2 years and didn't use her credit card, and so lost her credit rating. It was 0.
Oh, no.
So, and then there are certain things that you can do when you are establishing your credit. So if you got a credit card of $2,500, just put a couple $100 on it every month, pay it off, and make sure you don't go over like 50%, because they do look at how much you have in relation to your total debt.
Oh, absolutely. Yeah. Can you see that? I did the screen share and it should have come up.
No, no, I can't. I did not see it.
Try that again.
Do you want to send it to me?
Well, it's live on my Filogix, our software that we use. So it's gonna show through that. Safari share. Chrome lost. It doesn't seem to want to, but I can go over those in detail enough to really break down what we're looking at. So what I'm looking at over here is I've put together a file of Jane and John Doe, a young couple looking to make their first purchase. And those mortgage terms that I use, the GDS and TDS. So what the GDS is, that's your gross debt servicing ratio. Sounds very confusing. It's not that confusing. What that is taking into account is the principal and the interest of your mortgage. That makes up your entire mortgage payment. And that also takes into account your taxes and the heating. So that's annualized and then broken down into 12 months, because that's what we're trying to figure out, how much of your annual income is being serviced to pay this new mortgage debt, right? And all those things that go into it. Again, the principal, the interest, the taxes, and the heating. So what lenders like to see with the GDS is that it's not above 39% of your annual income. And that's really important because 39% is pretty much the max. So we like to land a little bit below that. TDS, your total debt servicing ratio, that takes into account all other debts that you have, where if you were to stop making payments, you would continue to incur interest. So that's any credit cards, lines of credit, auto loans, things like phone bills. We just kind of remove from our liability section from our application, because lenders aren't interested in your $100 a month that you owe to Bell. So the max of that is that they don't want to see that above 44%. So really, obviously, they don't want to see your over 50% of your income going towards servicing the new home that you're going to be having, right? So in this scenario that I drew up, both of our clients had 65K annual salary. I think I made John's a drywaller and Jane's an accountant. So, and so we had a couple different things that I added here. I added a few items to their liability section, just hypothetical credit card debts and auto loans. And that landed our GDS and TDS at 38% and 42%. So definitely within the guidelines. And the good thing to know that is if you are applying for a mortgage and maybe you're just like, we're talking fractions of percentages over these guidelines, if you have strong credit, lenders will make an allowance for that and still give you an approval, because if you have the ability to pay off your credit on time and you don't have any delinquencies on your credit bureaus, then they see that, okay, you're responsible with your money. So they're willing to make those allowances.
Okay, so I have a question. The credit rating is a score out of?
900.
And what's a good credit rating?
So a good credit rating would be anywhere between 700 and 900. It's kind of, they're all good. I mean, once you get down into the 650 range, that's when we start getting questions from the lenders. If you're between 650 and 7, they may ask a question like, oh, why is the credit rating so low? But usually it's a whole blueprint, your credit bureau report of, okay, maybe you only ever had one credit card on your file and you haven't built up a strong portfolio of credit, which is funny because, I mean, that's just the world we live in. You get better credit by having more lines on your credit bureau. So we are in a world where the more credit that you service and pay on time, the better your report's going to be. And I have seen a 900 before. It's very rare, but they exist out there.
Also, I'm just thinking there can be times when you've had credit or you've like owned a car or whatever, and you've had a loan and you've paid it off. And so these things come up. This is why you want to get this all checked ahead of time, because these things come up in your credit bureau and they show as not being paid off. So often you have to get those cleared as well before your mortgage goes through, right?
Absolutely. I've had to do that a couple times with some clients, and honestly, getting in contact with Equifax to say, hey, why is this trade line here? They pick up the phone really quickly, and it's usually a relatively simple process. Being, no, that's been cleared out. I don't know why that says that. Sometimes people would say, well, there's a collection agency after me. And those things can be mistakes, or maybe it's just something that happened and you forgot about it 10 years ago and there's a $27 balance. That has to be paid off and dealt with before a lender is going to cough up all their money. So yeah, again, it's good to get that out of the way. Sometimes I'll have clients worried about what their credit looks like because maybe they've had some inquiries or a couple of inquiries in the past year, and they'll say, oh, I don't want to pull my credit yet. That's hard for me as a professional to say, oh, okay, well, where do you think the credit score is at? Like they say they don't want me to pull it, but I can't do my job and confidently say you can afford this if I can't get a good look at how things are and what other debts you're servicing. Because sometimes folks will think that those personal loans don't count towards their credit score or those lines of credit, and it's just credit cards. So it's very difficult to give people an accurate response when they don't want to share all the details up front.
Yeah, and I found that in the past also with other clients who've been like not fully forthcoming, and they've gotten irritated with the broker because with like somebody in your position, because you're asking the question, you're like, I'm asking the question because we need the full picture. We need the full picture because the bank wants to know who they're financing, right? What's the
exactly, yeah. And honestly, if you think about it, me asking them up front and saying, hey, we need to get rid of this potentially like stress point for us, because down the road when the lender finds out, and they always find out, it's going to be the delay of the back and forth, closing's coming up, lawyers need to be instructed 2 weeks before closing. And if we're inching closer and closer to that deadline, the client's stress is going to be so much higher. So trust your professional mortgage broker that you're passing off these documents to, that we're obviously acting in your best interests, because we want a smooth process for you. We want to be able to service you the best we can. And so we're not just asking for documents and this and that because it's fun. And we're just trying to guide you through the process to make it as stress-free as possible.
Okay, so what's the timeline here? They meet with you, they have their discovery call, then you tell them what documentation you need, then you do your strategy call, then usually they call me, they tell me what their budget is. To me, there are two budgets. There's the budget you're approved for, and there's the budget you want to spend.
Yeah.
Right?
Absolutely, yeah.
And then they write an offer with me. Then they have 7 to 10 days. I send a copy of the offer and the MLS documents and Form B, if it's a strata, to you. And then how many days do you need? What do you need now?
Pardon me?
What do you need now? Because I know that can change.
So assuming that we have all of our documentation, and the only new documents that we may need is if that we've been speaking for over a month or two, then we may need new job letters and new pay stubs, because they have job letters and pay stubs have to be dated no longer than 30 days of the application submission. So we may need new job letters and pay stubs. So it's good to, if you think that you're seeing a place and you're going to put in an offer, make sure you tell your HR or your supervisor, hey, we're going to act on a property. Maybe issue us a letter just in case, right? They have them templated and they drop in your information. Shouldn't take too much time whatsoever. Then from there, in slower times in the market, we can have commitments back the same day. In really busy times, especially throughout COVID, because the lines are jammed with folks trying to deal with deferred mortgage payments and things of that nature. It can take a few more days, but within 5 to 7 business days is definitely a generous amount of time. Usually you can get it done in 3.
Okay, I'm not telling my clients that. All right.
I say 3, I meant 6. I meant 6.
I'm just kidding. I always figure just get them a little extra time because first of all, it depends on the lender and who you're submitting it to and who the underwriter is and all that stuff. Okay, so the question, buying a house with or without a suite, good or bad?
It depends. I have some folks reach out that they simply don't qualify for a traditional mortgage. They say, well, let's why don't we find a place that has a basement suite and that'll help us qualify. Not really how that's going to work, because if you don't already qualify, using 100% of that rental income isn't going to get you below that bar. You'll just be writing off the debt that you can't already afford. to kind of put it bluntly. So it's fantastic for folks who already qualify, who want to be able to write off their mortgage expenses by having a tenant in there, or at least a portion of them, to have the tenant chip in that way. But yeah, there is a misconception that having a rental suite with your investment will make you qualify, where more often than not, I have folks who don't qualify asking me for that. And I mean, there's also alternative lending, but that's a whole other conversation.
Also, like I always say to somebody, first of all, you have to have the mentality to be a landlord, because if you get a bad tenant, oh my God, it's the worst thing ever.
Absolutely.
And you can literally ruin your house by having the bad tenant. So you have to be of sort of a strong mindset to have tenants. Okay. And then the other thing is that I think you should be able to afford your house without the suite. The suite is just the bonus, right?
Absolutely. Yes.
Okay. What about conventional mortgages versus unconventional? So conventional, it's funny, whenever we have to fill out a form when people sell, and we go like, we're supposed to say, where are they from? And are they financing through conventional or unconventional? So conventional is more than 20% down, but I would say now a conventional is probably under 20%. Like, how many people actually have over 20% down?
That's a good question. I'd want to look at my statistics and see where my all my past clients kind of land. But no, you're absolutely right. I mean, especially folks trying to get into the market and being priced out, people want to act as quickly as possible, and maybe they haven't built up enough of a down payment to avoid that default insurance that's attached to those high ratio mortgages, right? So, I mean, the difference really, there's kind of three blocks of mortgages. You have your insured mortgages. So you're putting down less than 20%, and the mortgage is going to be insured. And the important thing to know about that is that insurance is called mortgage default insurance. That's paid by the borrower, but it protects the bank in case you default on your mortgage. So that's kind of the risk that they're taking, saying, okay, yeah, you can put down 5% for this $500,000 property, but you're also going to pay our insurance to make sure that if things go sideways, at least we get our investment back. So that's the trade-off there. And then you have your conventional, where you're putting down at least 20%. And
conventional, yeah.
Yeah, you have your conventional where you're putting down 20%, but it's under $1 million. So that's probably where most insured and conventional is where most folks land. And then you have your uninsurable. And really what that means is that you're purchasing a home over $1 million. So conventional runs all the way up to $999,999.99. So 1 penny more, and you're looking at an uninsurable mortgage. And the main difference with that is that the main difference with that is that it's over $1 million, and your interest rate is going to be slightly higher. There's a bit of a premium for that. So I get folks who are like, oh, I'm looking at this property for 1.7. I got my 20% down. We're good to go. Fantastic. But you need to consider that just because you're putting down 20, you have to put down 20% for a property over $1 million. But one thing most folks don't know is that there is a sliding scale with how much over $1 million you're going to go. At 1.5, they may ask for an additional 5% down. It's very different from lender to lender, so we can kind of go to the one that fits your budget or how much you have available. But definitely something to consider, that it's not just 20% down for a $5 million home, that's going to be a very different down payment, and something you need to consider up front.
Right. And so that's often why people list properties at $999, because they get people who are getting conventional mortgages wanting to purchase it. And then they get people who can afford more, who can go the unconventional route.
Exactly.
Okay. Why is down payment verification so important?
So this one gets tricky, and is something that I've made sure that I have a very open conversation with my clients up front about where their money is coming from. If some folks like to move their money around so much ahead of closing, it's in an RRSP. They withdraw it with their first time benefit, and they pop it into a TFSA to let it gain some interest for a few months, and then they throw it in their checking. Then they throw it in their spouse's savings account, and money's just going all over the place. What we need is 90 days banking statements from every account that money has touched. So if it's been moving around a whole bunch, if it's a gift, we need to know where the money's coming from. And simply that's due to the Anti-Money Laundering Act, especially since the housing crisis in the States, and then through COVID, people have become very savvy in finding ways to kind of get around the rules. And lenders are getting extremely strict with knowing exactly where your funds are coming from. So it's good to, don't move it around as much. If you want to leave it in a TFSA so it can gain some interest, fantastic. But don't have your money hopping all over the place, because if I have to send you out to go get bank statements from wherever your TFSA is being held, from your RSP, from 3 different checking accounts, you're going to get incredibly frustrated. And this is typically the most time-consuming part. Once you have your mortgage commitment, we still have a list of conditions we need to fulfill. Number 1 is going to be down payment verification. It's easily the most important to the lender to make sure that the money is, for lack of a better word, clean.
And you need a gift letter just in case as well.
Yes. Yeah. And obviously you need a gift letter from your donor. And if the money is already in your account from your parents or your direct family member, that's fine. But if once you've got your commitment, then the money transfers over, the bank has the right to ask for your parents' 90 days banking history so they can confirm that it did in fact come from them.
Oh, interesting.
Yeah.
I didn't know that. That is a little twist.
Yes. And obviously then that's a whole other conversation, and the parents are wondering, why do I have to cough up my private banking details? That's the price of doing business and getting a nice big loan to own a home.
Yeah. Just keep it simple.
Keep it
the
simple.
Other thing,
yeah.
People have an agreement with your parents regarding that gift letter. So make sure it's very clear if you do or do not have to return that money, the bank has to see that.
Yes, banks will not allow gifts with this side conversation that, we are going to pay it back. It's just a temporary loan, because then that's, again, something that needs to go in your liabilities. It's like if you had a personal line of credit and you use that down payment, that money for your down payment to buy the home, that's obviously got to come out, and we have to account for that in your debt servicing ratios.
Yeah. You could give them a percentage of the house too. That could be
put them on title and give them 10%.
Okay. So what if people don't qualify? So I have a friend who lives in the Maritimes. She and her husband actually are alternative lenders. So what does that mean?
So the alternative lending scene has just been growing exponentially. There are so many different lending solutions for folks who don't meet those debt servicing guidelines of 39% and 44%. And these alternative lending solutions are still fantastic, and they can go up to 65% of your annual income so that you can get a home. And the thing is, obviously, folks, they want to see the lowest possible interest rate for their mortgage, because that's a nice piece of bragging conversation when you're having a barbecue at your friend's place. But these rates, they start at about 3.5% and then go up from there. 2 years ago, the going rate was about 3.9% for a fixed mortgage. So if you're desperate to get into the market, hesitant about going with alternative lending, I would kind of take a step back and reassess, because when you're looking at today's rates, we call it 1.7 for conventional, that's probably a little bit high, to 3.5%, maybe a little bit higher. It's all pretty relative, and the opportunity to get into a home and start building equity is so much more important than the bragging rights of having a slightly lower interest rate tied to your mortgage. So there's a lot of different lending opportunities out there for people with, I mean, all the different various types of financial situations that I've seen from folks. Some of them say, oh no, we're not quite there yet, but you can move into these programs. And with some lenders, they have graduation programs. So let's say you go with First National, they have a graduation program that you'll be on their Alt A side. And then in a year or two, without refinancing, you can requalify for that mortgage with your rebuilt up file and graduate yourself into their A program. So there's a lot of great opportunities out there, and yeah, people should be looking.
I think people just have to be really careful, because if you have like primary and secondary lenders, sometimes somebody can pull the loan in. And depending on the terms, and so they can actually hoop you. And I've had that happen with a client where they went with a sketchy lender. So you really want to go with somebody who's professionally recommended, not a private individual who may decide to call the loan on you and then repossess your home.
No, absolutely. Yeah. Not all lenders are created equal. When you get to that B Alt A private side, you're looking at far less regulations. And so it is important to really understand who that lender is. You should have a lot more questions as a buyer if that's the direction you're going, and really look into that lender and make sure that they're a right fit and that they've got a good track record.
Okay, awesome. Okay, well, thanks so much for giving us so much to talk about today. Oh my God, it was like, love it.
Sensory overload. Yeah, there's just so much that goes into a mortgage. And I mean, that's what I love about this industry, is that it's, especially over the last year and a half or so, it's constantly changing. Lender policy is constantly changing. So having a constant open dialogue, if you're looking to buy with your mortgage broker, is incredibly important, because things are constantly changing.
Okay, so how do people get in touch with you, Anthony?
So you can find me at ratedesk.ca. That's our company website, or Mortgage Architects. And you can email me at anthony@ratedesk.ca, or reach me 250-686-0383.
Awesome. And if you want to reach me, if you're interested in getting an update on what's happening with the market, you can call me. My name's Jane Johnston. I'm with the Briar Hill Group. You can reach me at 250-744-0775. My email is briarhillgroup@gmail.com. And I have two websites. One's on neighborhoods, called VancouverIslandTime.com, where we interview local entrepreneurs about where they live and their business. And my other one is briarhillgroup.com, where we interview people about real estate. All right. Thanks so much for joining us today. It really was very informative, and you're a great speaker. So appreciate you coming on.
Well, thanks for having me, Jane.
Okay. Talk to you later. Bye.
Yeah.